Hello, everybody, and welcome back to the M3 Melody Market Update. My name is Melody Wright, and I do this show to give you context for what's going on out there, really in the macro land. We focus a lot on housing and commercial real estate, but you cannot focus on those without understanding that bigger backdrop. So, very excited today to have with me two folks that I've been working very closely with over the last several months around some of this distress we're seeing with the consumer. So I've got Lux Ganapathi and John Comiskey with me today. Lux, why don't you go ahead and introduce yourself, and then we'll turn it over to John.
Thank you, Melody. Thanks for having us. Thanks for having me. We are an independent research firm, but we are, as a part of our research process, we've been focusing on consumer credit availability. And the way we focus that is in the credit markets as well as in the equity markets. And most importantly, how a single decision made by an administration or made by anybody in the enforcement department will cascade through all aspects of the economy, and at the end of the day affects the bottom line of the consumers. And that's what we have been focusing on, and we do publish our analysis in our newsletter. But thank you, Melody, for having me.
Oh, it's thank you for joining. Very excited, John.
Yes. And likewise, happy to be here. I am John Kamiski. I'm the author of the Reverse Engineering Finance Substack. I conduct independent research into things like treasury spending, what the TGA is going to do, but more related to the discussion today. I've been doing a lot of research into what's happening within the country's mortgages vis-a-vis the mortgage-backed securities disclosure data, which gives me a pretty good view, a pretty good look on the vast majority of the country's mortgage activity and what's going to happen with that as a result of policy, either existing policy with respect to loss mitigation, the impact that has on mortgages, particularly on the FHA portfolio, and then more recently on student loans and the repayment of particular student loans and what impact that's going to have on, or what the intersection is of student loan borrowers and mortgagers across the various housing portfolios.
Excellent. Thank you. And I mean, and some fabulous work on the FHA stuff, just really putting together life alone profiles that gave us a view into what's really happening with that. I'll call it ridiculous program. And so, I mean, it was unbelievable the work that, both of you guys have been doing. And I feel very honored for you guys to be here today. And Lux, and really, you said something before we even hopped on about how we really can't even discuss like the economy without talking about the policy because of where we are today, right? And so, and I think none of us want to be talking about politics. I know I don't want to be talking about politics, but we have to pay attention to what's going on. And so I think what I'd like to talk about first today is just student loans. We'd all been, at least I had been watching it, talking about it, thinking about those impacts. But, for the longest time, I was convinced that probably they would not get paid back. Not so much that I just believed the last administration, but more so that I just couldn't believe any politician was going to be okay with like shutting down that much consumption because they'd have to redirect that $800 a month, directly to the government versus into, through consumption. I just didn't see that they would and then, by the way, most folks just don't even have that $800.
Yeah.
But I think I've been surprised just by the level of distress that we're seeing in the student loans now that they're being reported. And that 20% delinquency that the DOE came out with, not the Fed schedule, because that was around 8%. And what that means now to all of these sectors that we've been looking at, I think this is kind of it's a moment in this cycle where it feels like it's that moment when people realize that there's no turning back in this economy, that, hard landing is next. But what do you guys think about like the student loans?
If I can go first, to have a detailed analysis, everyone is welcome to go to my Substack, contrarianunicus.substack.com. We have, as of 2025, there are 6 million at least student loan borrowers who are 90 days or more. And you're right, we can't talk about any aspect of economics without talking about the administration. So now 6 million federal loan student loan borrowers on 90 days past due, it triggers and they get reported to credit agencies. And it started around May 2025. And the Department of Education, Melody, as you mentioned, came out and said, we are going to garnish for wages, we are going to garnish Social Security. I believe 450,000 of the student loan defaulters, give or take, are 62 or older in the age range. So their Social Security were expected to get garnished effective later June 2025. 2 days ago, the administration came out and said, oh, we are not going to garnish anymore, because it's going to take a hit of 15% of garnishment from, I don't know, $3,000 a month from the Social Security, give or take. But that is not going to do any good, because we did a deep analysis into the one big beautiful bill, and there is a lot to unpack. And one of the things that they focused on is also Medicaid. So you don't garnish the 15% from Social Security beneficiaries who defaulted on student loans, but if the bill were to get passed, they will get impacted in Medicaid. And we have gone through step by step how they will get impacted and the cascading effect it will have on. And one of the interesting things we found is, oh, well, there are some documentations that they need to give. So their Medicaid won't be affected. Their student loan garnishment won't be affected. And we will talk about the SNAP cuts that won't be affected. But here's the problem. We don't have the data. I don't know if you do or John does. What percentage of those Social Security beneficiaries are in the nursing homes, and what percent of them have severe Alzheimer's? And people who are taking care of those Alzheimer patients, will they do the necessary things needed so their patients Medicaid won't get, SNAP benefits won't get cut? And we also targeted to the areas in which the SNAP benefits will get most impacted, the areas in which the Medicaid will get impacted. This is not being discussed. This is not being factored in the mainstream media. This is not being addressed by any politicians. And I don't know, am I the crazy one, or are we the crazy ones to focus on this? Or it gets worse, Melody. The student,
Yeah.
I mean, even if they backpedal on the garnishments.
Yes.
So, no one controls the credit agencies, and every time this gets dinged, it gets reported to the credit agencies. And I think we covered this multiple times. A couple of gentlemen had like a 750 credit score. Because of the student loan default, they got dinged 200 points, which is putting him near subprime.
Right.
John, I would love to hear your take on this too.
Yeah, and quickly, I just want to say, so this is I think that student loans, we're starting with them because every sector that we all talk about is going to be impacted, and to me, this was the Great Awakening. I think there were two big stories out there that were the Great Awakening for folks on. And by the way, I'm not saying everybody's awake yet. I'm just saying that when we look back in history, I believe these were the moments that we had a bigger awakening about the health of the consumer. It was around the FHA, which John and I have been focused on, but who cares about mortgage land, but it's the FHA and it's also the student loans. And those two things combined, I think, have really brought an awareness to everyone that perhaps things weren't as good. And I'm not saying everybody's fully aware, but we're starting to get so many more articles out there about sort of these issues because of these credit score impacts. But John, I'd love to turn it to you now, just kind of talk about your work with FHA and then how it's sort of, the crossover with student loans and then what we know is going to happen, October 1.
Yeah, so I would probably break it out like this, right? There's a question of what's happening now and what is going to happen. And when you apply that to the student loan portfolio, it's interesting because like the folks that lock sites who are not paying now, a substantial number of them, these aren't the really high balance student loans, because those high balance student loans by and large sit in the income driven repayment plans. And the vast majority of that is SAVE, which is still in forbearance. So unless you are, just ghosting your student loan servicer or didn't choose a plan or whatnot, and I'm sure there's a handful of folks like that, for the most part, these are relatively low balance student loans, probably from relatively low income families that are not paying their student loans right now. They're also unlikely to be mortgagers, but that's the distress that's hitting now. That's the distress that's hitting the credit scores. It may not be garnished from Social Security folks. Remains to be seen whether or not they'll garnish from W-2 style employment or not. I mean, from a political angle, it's probably more challenging political optics to garnish Social Security from somebody who really does rely on that to live on, right? Versus somebody who is in a W-2 garnishable situation, even if they really kind of need that money to live on as well. Just the optics are about as bad as it gets when you're garnishing Social Security.
Agreed.
Social Security. So I don't know, right? I don't know what's going to happen there, but what we haven't tapped, and who doesn't actually have to pay right now, are the folks, ironically, in the income-driven, or the vast majority of the income-driven repayment, particularly the folks in the SAVE plan. I mean, they're still in zero interest accruing forbearance. So you have the what's happening now, which when I look at the K is like the really low leg of the K, who's getting hit and being put against the wall right now, and then you go up on the lower leg of the K. And that's what's going to hit later on this year. So you mentioned October 1st. For anybody who hasn't watched you or one of us in the last month or two, what happens October 1st is the FHA loss mitigation procedures tighten up significantly. And what you have now is effectively endless loss mit. Like so long as you engage with your servicer and you don't abandon your property, you will either get a partial claim, which will cover your arrears and bring you current, and might give you a payment reduction if you want to go that route. Or even if you've exhausted all of that, you'll get a modification, which will bring your loan current, may increase your payments, may be completely pointless, doesn't matter. You'll still get offered it and you can still accept it. And that'll happen for another, 4 months now, until we hit October 1st. And that's when the FHA, the music stops for FHA mortgagers who are in distress. So now we're kind of, up from the very extreme bottom of the K to the lower leg of the K to a little further up for those FHA borrowers who are genuinely in distress. And they're going to face a reckoning in October of, can I find the money to actually make this mortgage payment, or not? And if I cannot, then I'm going to face forced sale, or I'm going to face foreclosure. And then you have part two as we go even further up the K, which is going to hit sometime in the first part of 2026, when repayment on those SAVE plans, and other income-driven repayment plans, which are which were invalidated by the injunction, becomes required. Again, it's contingent on the One Beautiful Bill passing and the student loan overhaul within it being largely untouched, with that, which I think is a highly likely event, because it's a source of savings from a CBO perspective in the One Beautiful Bill. So I don't think the Senate's going to touch it much. So that will force all these save plans that are in, don't have to make a payment, interest is not accruing, forbearance, into a new income-driven repayment plan, which is going to take effectively 15% of their disposable income, which is 15% of their adjustable gross income minus, I think, 150% of the federal poverty level for their particular family situation. That's a big chunk of money for somebody who's making, say, $60,000, $70,000, $80,000 a year. It's more, and that you're going to go from a $0 payment on that student loan to maybe a $500, $600 payment a month. And that money has to come from somewhere. And so you've got student loan hitting at the same time that mortgage, with respect to FHA, mortgage is requiring a repayment. So there's kind of, it's a two-part thing. You've got what's happening now and you've got what's happening to come.
Yeah. And so, big deal when essentially we're going to suck that money out of some other sector of the economy, right? When they have to pay, because wages, we won't be seeing an increase in wages. Right now we're seeing increases in layoffs and bankruptcies. Unless there's something, I have not personally read the Big Beautiful Bill yet, but are there anything in there to add a significant amount of jobs between now and first quarter of 2026?
Well, there is, if I may, we were reading the Big Beautiful Bill, and from multiple point of view. We read it from the point of view of how it's going to impact the student loan. We read it from the point of view how it's going to impact Medicaid and Social Security benefits. What's interesting, the Big Beautiful Bill is, to go back a little bit, we've been tracking corporate downgrades, defaults, and bankruptcies. And we found an overlay between that and the Big Beautiful Bill. If it were to be passed, there is going to be a spike in layoffs further than what we have, especially on the SNAP aspect of the bill. The SNAP aspect of the bill, it's the food stamps, and it's not about cutting the food supply from the people who rely on them. They also going to tank the credit scores. They're also going to increase the auto repossession, the cascading impact, and they are going to just trap the people who are already in debt. So it's not about they backtracked on garnishments of student loan. It's about, while the student loan defaulters are being reported to the credit agencies, they see a fall in the credit scores. So you have prime consumers fall into the subprime categories, and that's happening fast. And as it's happening, the people who are not student loan defaulters, they are starting to see their credit being cut by the credit card agencies because of their splurging, because of their increase in the auto loan payment, and because, like John mentioned, you have to start paying mortgages from in the FHA from October, whatever the reason. But the SNAP cuts in the Big Beautiful Bill is going to cascade into impacting credit score repos. So how it impacts, to break it down, how a SNAP throttling or the rule changes in the Big Beautiful Bill is going to impact the credit score is because SNAP usually frees up the cash for other obligations. So like we were discussing before, you can allocate it to rent, you can allocate it to credit card, you can allocate to the auto loan. But payment history of like 35% of the FICO score, even one missed payment can knock out like 50 to 100 points.
Oh,
So
yeah.
on top of the student loan default credit reporting, another impact, it's just people are just completely wiped to
Yeah. If
Yeah,
I could, if I could kind of rephrase it a different way. So essentially, let's say, that as we were talking about before the show, you've got that $400 has to come from somewhere, and so
yeah,
maybe someone starts to put $400 more on their credit card each month for food because they simply cannot afford to buy food, so they're using a credit card, and so that credit card, because they are near subprime, they may have had a late payment or something like that. They're going to be paying the highest interest rates on their credit card. And each month, as they pay that minimum payment, or maybe even just a little more, that interest starts to compound. And each month you have less and less credit to actually spend,
yeah,
out there. And so this has a cascading effect. And I want to go to autos now, and
yeah,
I think at the end, I want to really dive into this snap because I
yeah,
think it's important. But with the auto sector, I mean, we are already seeing significant prior. And let me back up and say, prior to what was going on with student loans, I was seeing distress in FHA. You've been tracking the distress in auto. So it's not like this was overnight. This has been building, building, building. And the reason why, for instance, mortgage delinquency looks as low as it does, as you have things like non-performing loan sales where Fannie and Freddie sell those off to private hedge funds, which through my research I've found out a lot of them are using a servicer and a technology platform that are not reporting to credit.
no,
And so, they've been hiding the distress. So we've got this distress that's been building for the last 2 years, even as we've had GFC style intervention, even more steroids. Um, but it's been building and building, and student loans have kind of like pulled back the covers, and we now kind of understand what's going on. But Locks, take us through what you've been finding on auto, because I think this could be this smoke in auto. I think is the strongest of all the different asset classes for debt. Anyway,
Well, the auto is interesting because, as I continue to mention, the auto sector is um, very colluding, very interconnected sector. There is a relationship dynamics between OEMs and the dealerships and the wholesalers and the repo companies and bank. It's a big network. So it goes like, hey, if I don't do this, can you promise me that you won't do this? So that's what's been happening. So let me take you through that. Is that so consumers are not able to pay their auto loan, so they are calling, according to our sources, okay, let's take my car. I don't want my car. I'll figure it out. I don't want my car. I can't pay $200 $500 a month for this car. So the banks, which I can name, so there are banks, and the credit unions are the worst culprits, because credit unions are not, at least the credit unions that I know, are not publicly traded. So, most people don't pay attention to it, but their delinquency rate are through the roof. And they have been giving auto loans, and the banks who are publicly traded, they are giving auto loans. So when consumers are coming to the banks saying, hey, take my car, I don't want to deal with it, the banks are like, no, 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 sit down, let's have a conversation. How much can you pay? Can you pay like $100, 150? Can you just squeeze in 150 per month? And if they say yes, so their term loans have been readjusted from, I don't know, 3 years to 5 years or 6 years, and off they go, right? And that is now where it stops. So now, from the bank and customer side, you managed not to repo. But there is another dynamic. So the cars that are getting manufactured these days by OEMs, they are not of that good of a quality like they used to be pre-pandemic. So when you have problems, when customers who badly can pay the more monthly payment have problems with the cars, they go to the dealerships or they go to the mechanics. The supply chain aspects of the entire auto sector is another issue. You have the parts, the prices of the parts were all over the place. So you go to companies like AutoZone, okay, let me do it my own. And that's not working out for consumers because they can't afford. So we are talking about the subprime consumers and the consumers who are very, very near subprime as well. So, and then you go to the wholesalers. So banks right now have kind of increasing the repossession. So repossession happen when a consumer default on the loan, and when the loans are anywhere between 60 to 90 or greater than 90 days overdue. So the banks are repossessing the cars. The banks are repossessing the cars from the small dealerships, mom and pop dealerships, we are hearing, that are no longer able to pay their floor plan expenses. So they are repoing from the mom and pop dealerships. They are getting spike in voluntary repossession or surrendering of the cars. So the banks are sitting with a bunch of cars, voluntary surrendering of cars that the consumers can no longer pay. They are spiking. The repos from the consumers who are 90%, 90 days overdue, repos from mom and pop dealerships who can't pay for car expenses. And according to our sources, all these repos are sitting with the bank, and they are not reflecting on the bank's financial statements because they won't reflect until the bank goes around and tries to sell it at the wholesalers, right? So usually when you're trying to sell the repo car at the wholesalers, you have to fix the car before you do it. The word, according to multiple sources, is that they are not doing that anymore. They are repoing the car with a bad transmission or whatnot. And instead of fixing them because that costs money, instead of washing them because that costs money, they just take it to the wholesalers and say, as is. It's like pretty much dealing with junk. Okay, this is what I got. Tell me how much you can pay me for that. So what we are seeing is things are happening behind the doors and nothing is being reflected on the bank's balance sheet yet. Their provision for credit losses is not as high as it should be, both for the consumer delinquencies as well as for the floor plan delinquencies, because the second you do that, everybody will start questioning, hey, why is your provision for credit losses is higher? What are you expecting to happen? So
Right.
everybody is keeping everything, hoping that things will turn around. And then comes the student loan,
Right.
right? Then comes the student loan, then comes the FHA, and then comes this one beautiful, big, beautiful bill with, SNAP benefits being cut and how it's going to transfer to your auto. So SNAP
Right.
benefits cutting or adjustments going to impact the repossession. At
Right.
some point, the banks, which our research indicates even the third or fourth quarter of this year, right around the time John and you were mentioning about the FHA, they have to start reporting it on the books.
Right. Right. And you know that I worked for a very large auto lender. And so and know the business a bit. And what I can tell you about at least some of the my former company, they learned last time not to be first because we were first last time in mortgage write-offs, write-downs, because we had just been purchased by private equity who wanted a purchase price adjustment. And so we were out there like this poor redheaded stepchild early, just taking it. I mean, I come into the office, be like, we're writing down 800 million today, another 800 million. I mean, it was just it was insanity back then, guys. But they learned, don't be first because first is worse. And, of the big five that participated in all of, we were also a TARP recipient. They put the mortgage unit into bankruptcy and changed their names. They were GMAC and we were GMAC ResCap, and now they're Ally.
Yeah.
And I find it, people probably get sick of me saying this, but I just find it so ironic. Because I would be in every meeting, with the executives. It would be like mortgage, 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 dirty little mortgage. You guys, you're the whole
Yeah. Yeah.
reason this is all happening. Meanwhile, mortgage didn't get any of that TARP money, so they were starving the servicing operation, and they kept telling the street, we'll never get into mortgage again. And they just went and did it with autos, and they even started playing a
This
mortgage
is going,
again.
this is
Yeah,
going to be worse. They're not going to
yeah,
be first, but the problem is somebody is, whether it's student loan, whether it's a big beautiful bill, whether auditors finally wake up and decide to do
right.
their job, or
Yeah,
somebody is going to force the hand, whether it's Wells Fargo or whether it's Ally, but someone is going to be the first this time,
yes,
and that is going to collapse the entire illusion of, you know, and this brings back to the question of the Moody's downgrading the United
yes,
States. And everybody is saying, oh, Moody's is downgrading the United States. It's not a big deal. We can pay the bill. It's not about whether we are able to pay the bill. It's about the illusion that we will never be held accountable. We can do no wrong. And this Moody's downgrade is not about the US debt. It's about the cesspool of systemic issues on all debt, from auto loan, student loan, mortgages, and forbearance, and everything. So
yeah.
Moody's just
I
pulled the
think,
curtain down.
yeah, you and I talked about this, and we were in an interview with my friend Nobody's Special, and it was, I think, even after we were taping, and you had asked me, what do you think it's going to take? And I was like, it's going to take awareness, right? And I think last time what it took was the rating agency downgrades, and we had that conversation, and the next day, I think it was the next day or 2 days later, that the Moody's downgrade for the U.S. came in.
Yeah,
And then another downgrade for the long-term portfolios at some of the banks.
yeah.
And at the time you and I were talking, I was like, that's the shot across the bow. That's telling everybody. And honestly, I think that is the first signal that awareness is coming.
Yeah.
So I think we will probably see some rating agency downgrade in the audit sector, and
It,
it'll be too late as per usual. But
yeah.
that is going to be kind of the, okay, we're going to acknowledge the distress, in my
It's
opinion.
it's happening because over the past 4 or 5 weeks, there has been consistent downgrades higher than upgrades, and the rating agency, especially S&P, I mean Fitch is kind of but especially S&P has been warning. So and Moody's, before they downgrade, they put you on negative watch, and
Right.
and after that they're like warning. So they have put retails, restaurants, consumer credit, and auto, Carvana being one, and a couple of others, saying that, hey, we are downgrading these things. We are watching these things closely, but consumer credit, retail, restaurants, a couple of banks, and auto is going to be a problem. And if they don't fix X, Y, and Z, then the next step is downgrade. And what I
Right.
realized, and I spoke with our Amanda, who tracks the
Oh, good old. Mm-hmm.
yes.
The
So
job chick.
yeah, the
Yeah.
job check. So we spoke over the phone, and she was like, "How did you do that?" Because there is some correlation between negative watch to downgrades to immediately within like a quarter or two, the company starts to lay off people en masse. So this
Mhm.
is like coming from the credit side, and that is going to impact as well. I mean, I wake up every day thinking, are we crazy?
Yeah.
Are we are we seeing things that are not there and everybody is right? Or are we the only ones seeing things that are there and everybody is trying to? And John, I think you wanted to
Yeah.
add something.
I do. Like when I look at this from a macro perspective, I mean, I think about debt and, you know, there's two sides to a debt relationship. There's the person who owes, and there's the person or the entity to whom the money is owed, right? And they may or may not get paid back. When you take the case of student loans, the overwhelming person on the other side of to whom the money is owed is the U.S. Treasury, right? And the stance on that seems to be, accepting the Social Security recipients who are also student loan debtors. The stance seems to be, aside from that no, we're getting our money back, right? The Treasury is going to get its money back one way or the other. You're either going to repay it, or we're going to garnish your wages. And the same will ring true in the first part of next year for, honestly, the biggest tranche or I think what'll be the most impactful tranche of student loan repayers who aren't repaying. But you see it in other relationships, right? Like mortgage debt is another good example of it. Within FHA, again, ultimately the person who stands at the other to whom this debt is owed, while it's not in a literal sense technically the U.S. government, because the FHA insurance fund guarantees the loss and the investor is going to get made whole one way or the other, effectively, de facto, it is, right? And you're seeing the FHA saying, no, we're going to get our money back. The Treasury saying, we're going to get our money back. And if not, we're going to force you to sell, and we're going to minimize the loss that we have to pay, right? And then what does that do to the other debts? Because all the banks can do with auto is repossess, right?
Yeah.
All the credit card companies can do is give you a bad credit score, right? At the end of the day, which does, of course, impact you, but
close down your credit line.
Exactly, yeah. Right? But who?
Yep.
And so there's two questions. One lacks directly to what you were just saying. Who are the entities that are pretending that they're still going to get paid back without a big haircut, right? And then the second question is, for the consumers whose debt is going to get repaid to the federal government because they don't really have a choice, at the pain of, well, either they can just stop working altogether so they're ungarnishable, or they can stop, they can get, leave their homes so that they don't have that mortgage obligation because they give a deed in lieu or something like that. Who are the knock-on? What spending is that going to displace out in the consumer, right? Like, we live in a world where live in a country where our annual deficit is, I don't know, we'll just call it $1 trillion and 1.7 trillion ish, and the one big beautiful bill. Maybe it changes that a little. It's not. I mean, it's probably not going to change it all that much. We're going to still be in that general zone of deficits that we're running. And you think, well, how the heck can we not have that growth? Well, maybe we do at the very top end of the K, where that money is ultimately flowing to. But then what happens to the top end of the K when the bottom end of the K, who owes the top half of or the top end of the K a lot of repayment, right? Like, a lot of the top end of the K's assets are contingent or value contingent on the bottom half of the K repaying. What happens when that bottom half of the K gets squeezed? And that's what's starting to happen now, and what is going to continue for the next 9 months, a year, foreseeable.
It's going to be painful. And it's interesting you said about the debt, because I should just probably take a break, because I've been reading through this big beautiful bill from all perspective, and one of them is a debt. As of May 2025, it's roughly debt held by the public. It's 28 trillion. I don't even know if that's a real number at this point. It's just and in the breaking down, like the big beautiful bill with respect to the debt, so they are cutting everything, and the problem is, it's not about at the end of the day cutting something. It merely reallocates the government spending from like social safety nets, so to speak, like SNAP, Medicaid, and all the things, and um, pushes it to the defense buildups and tax relief. So the debt ceiling is raised, and the interest payment, which is a nightmare. Nobody wants to talk about it because it's a very, very bad, dirty conversation. And, it just keeps on going. And one of the things that I was just going through the write up that we did is low income, what they got out of this bill is pretty much no tax on tips, no tax on overtime. I mean, you work 4, 5, 6 jobs, right? And I mean, no increase in the earned income tax credit, SNAP, Medicaid subsidy cuts across the bottom of income distribution. So, and I was just like, okay, so it's a simple math, right? You need to have revenue to pay the expenses. So let's look at this from the entire country. Where is the revenue not coming from? And nobody is going to like this conversation. And then I looked at the corporate income tax, and that's going down. So if hypothetically speaking, corporate taxes are being paid as they should, then we have something going, right? So the federal government is collecting the lowest corporate tax of revenue from the corporations. Am I so naive to think that? It's just because the income tax from the public is being constantly flowing in, but that is not enough to maintain the expenses as a country we are making.
Yeah, I think we've gotten to a point of, honestly, where, I don't know how much longer we can go like this with debt like this, but I think that we've gotten to the point that we're in a real bind, and it doesn't matter who's at the helm, what candidate is there. That we have really put ourselves in a box, and there's not much that can be done. And there is going to have to be real pain, and we know most politicians don't really want to go there because then they get in trouble with the lobbyists, because it's
The
not really
reality.
their constituents who they care so much about. This is just a system we're in right now. We have to acknowledge it. And so I think that, I've been listening. I don't know if you guys follow Russell Napier or people that, really understand or what they think is next in this fiscal dominance regime. But essentially, I think that we're at a point, we're moving in a direction where we're just in a box. And so there will have to be, and so I do think we ultimately locks get there to having to address the imbalance that I see in those corporate tax, they always skirt them, I've worked for companies that have done all kinds of crazy things, going offshore to get that down to 9% effective tax. I mean, there's just so many companies skirt the taxes. So I think we'll ultimately get there, but right now the political will is not there,
Yeah. I mean, I was just like poking around and saw the 2017, I don't know if you remember, the Tax Cuts and Jobs Act slashed like corporate tax from 35% to 21. And that reduces the revenue to the United States government by nearly approximate of 1.5 trillion for the next 10 years. Like every decision government makes, like whether it's today or tomorrow, no matter how small, what I'm freaking out about is that small decision has cascading impact and it compounds over the years.
Right. And so, John, I know you track a lot of the payments. What are your thoughts on that sort of, if not solution, just kind of where we are right now in the,
All right, so I mean, couple of random thoughts. Just looking at the system mechanically. I mean, one of our big expense line items, right, within the federal budget is interest that we pay on the debt, right? Either directly through coupon payments on the coupons, or through the bill drop. Bills work a little bit differently, but you pay the effective equivalent of interest on bills as well. And particularly with so much of the Treasury funding that's been shifted to bills, to the short end,
Right.
That Federal Reserve rate actually makes a difference with respect to what the budget deficit is. I mean, if Powell drops the interest rate down to the zero bounds, in an emergency meeting tomorrow, it would cut a big chunk off of the deficit. Now, there's myriad of other effects that would happen, and maybe as I've seen speculated by accounts and folks that I have a lot of respect for on X, maybe that would send the long end to the moon. But from a U.S. Treasury perspective, they wouldn't have to pay those rates until the next 10-year, 30-year auction, and then it's just 20 billion, 30 billion, whatever at a time, when you're at the super long end. So I think that probably partly explains that pressure. But when it gets, or the pressure from Trump and Bessent to Powell to lower rates, because it helps from a deficit perspective, I think whatever its other effects are notwithstanding,
Right.
when you look at it from a just a tax perspective, corporate tax versus, you have to tax where the money is, and be that money as it's flowing through corporations, or taxing that money once it's been effectively passed through from the corporations back to their equity shareholders, either through dividends or through share price appreciation, et cetera. You have to tax the wealth where the wealth is, and that's where the political will to not do it is. And instead, there's kind of the political zeitgeist has been don't tax at all,
Right.
which, the problem with that is the government's entirely in the business of wealth distribution and redistribution. That's what government does. And it uses its force to back who has whatever wealth, and then it uses policies to redistribute, and hopefully that all contributes to the growth of real wealth in the economy. More roads that are paved more frequently, and more bridges, and more
High speed rail. Can we do something like that?
Whatever, right? Better stuff
Please.
that makes everybody's life better. But
Right.
But the way they do that is through through essentially wealth distribution. So if you want to balance out our deficit, and not deal with balancing our deficit by issuing effectively more debt, which is effectively more money supply, then you have to go and tax that wealth where it is, and that's where there's not really a lot of political will to do.
And that is such a great, that's a great way of saying it, John. And it's very simple, right? Like, and I think that this is what we're seeing from BBB, is that and I think it was you that stated it so well before we even jumped on, is that the noose is tightening around the bottom of the K. Through this bill, and locks, as you've been kind of referencing throughout this entire conversation, this reduction in Medicaid and the SNAP benefits. Where I live, people rely on that SNAP. I live in East Tennessee. It's a very impoverished area. And when we're talking about SNAP, this is old food stamps. That's what it is. And what we've done is you give people like a little card that looks like a debit card or a credit card. And so you don't really know that they're using SNAP. Now, if you know what one looks like, they're using SNAP. And in many ways, I said to my buddy Jack, I was like, the bread lines are coming. He's like, Melody, the bread lines have already been here through SNAP. And I'm like, you're right. It's because they've hidden it. I think this is the big part of what's been going on since 2007, is just a lot of obfuscation of how much distress is out there. And so if you use a little card at the machine instead of standing in line, however, the food banks right now are at capacity. Like we've been to a couple of my trips across the country, but just any food bank, Google it. There's an article, and they're talking about they're feeding the people that are employed now, and so it's and homelessness is the highest that it's ever been in our tracking, and so we are a country at the bottom end of the K that is in
Yeah.
severe
Yeah.
distress, and so I think the political will is not there yet, but I think you keep sort of tightening the noose around the bottom end of the K, and then things are going to get really tough out there. And also Trump's base, there are a lot of people that are in the bottom of the K in
Yeah.
Trump's base.
Sorry, go ahead, John.
No, I was just going to say, I totally agree. It's ironic because the bottom
Yeah.
end of the K is, I think, what got Trump elected.
Right.
And this bill is not, it's not terrifically favorable for them. And, but Trump's got this massive cult of personality. Will the real world impacts of the passage of the one, the one big beautiful bill, will that hurt him politically next year? Well, and not him directly, but his party trying to remain in power. Sorry, Lex, go ahead.
You were saying, Lux?
Oh, sorry. I'm going through, like, when you said it's in the community of states where the SNAP will impact heavily. So the states with the highest SNAP participation rates, I'm just trying to figure out my notes. New Mexico is 21%, Mississippi 20%, Louisiana 20%, West Virginia 19%, Kentucky 18%, Oregon 18%, Alabama 18%, South Carolina 17%, Maine 16%. I mean, I just did this top 10, and it's going to wipe out the entire base. If this bill were to go through without any kind of adjustments to the SNAP, we have a problem. And it cascades from, it's just not the food. It just reallocates their discretionary or whatever the minimum they have to either the car payment or the mortgage or this or that, or whether I am going to let my family starve, or whether I'm going to ride a car, or whether I'm going to pay the mortgage.
Right. And I think that there's just been a lot of, obsession around millennial and Gen Z talking about their Starbucks, their avocado toast, their experiences. And I think that we see a lot of talk like that because we're trying to hide what's actually going on with the most distressed out there. And I think, when the unemployment rate for those with a 4-year college degree is the highest and it's in double digits, like that is really a problem for what comes next. And so, I see things happening at the top end of the K. So wherever we are right now, I think we have to keep it simple the way that John did, is that it, like, whatever's happening right now, all this noise, and by the way, there's so much noise out there with all these headlines, they will have to tax where the wealth is. They will have to. And so that's probably going to end up being a correction in equities. It will probably be part of that. They will probably have to tax, raise the corporate tax. So whatever we feel, that doesn't really matter. I think that's what I'm getting from both of you guys, is like, we can feel this way about a lot of things. And I think I still have a bias that there's going to be intervention. But when I hear you speak, John, like, even if they try, they're going to have to go. They're going to have to tax where the money is.
Yeah.
So
and they have to do the corporate tax. Otherwise, but I don't think that will happen, especially considering the current administration. So they raised the debt ceiling. So we are going to borrow more. We are going to take on more debt, like it's going out of style. My take won't be popular, but it's the realistic take, considering what's happening. So if you are going to just pull the band-aid and tax the corporation, and then tell the corporation not to shift the jobs abroad, then the corporation would, if you force them, they would say yes, but the iPhone is going to be $6,000 or $3,000, and no one is going. So it's going to go back to inflation being high.
Yeah, we're in a real box.
Yeah,
So
you're trapped.
yeah, so any last? We'll kind of wrap up the discussion here, and I'll give each of you just kind of last thoughts. I think to me, I feel like the kimono has been opened somewhat for those that are paying attention, and there is awareness for those that are paying attention. There will be broader awareness in the months to come. I think, the consumer starts getting really aware in the fall, and then definitely in Q1 of 26. And I think that's some great work you've done, John, just looking at that. But I think that we have entered a moment and where suddenly everybody has an understanding, and as again, not everybody, but has an understanding that things are not as good as they thought they were. And I'm seeing this all over social media. I mean, just these comments, like suddenly people are paying attention. But John, why don't you give us just any of your last thoughts and then end with where people can find you?
Sure. I mean, I guess the thoughts I would leave folks with is, consider the mechanical effects of the policies, and what's going to happen. Like, even we've talked about SNAP and Medicaid both being impacted by the One Big Beautiful Bill, right? Well, when you think through the mechanics of SNAP, that's less effective money in people's pockets. That's a very direct impact. Yeah. Less money for Medicaid, less clear, right? Perhaps it's less healthcare for people who can't otherwise afford it, but then maybe they just don't go and they just don't get the healthcare. And when you think about it in a dollars and cents perspective, it's less money in the providers' pockets because it's less business that's coming to them, right? Both are impactful in their own ways, but they have different economic impacts. And my closing thought would be to encourage viewers to think about economics from that perspective. What are the mechanical effects of what's actually happening? And in particular, what are the mechanical effects going to be of the One Big Beautiful Bill, and when are they going to hit? And along with the FHA loss mid tightening, because that, unless something changes, is going to be a pretty significant hit come the last of the year and the first start of next year. If people want to find me, they can find me at John Comiskey 77 on X. They can also find me at Reverse Engineering Finance Substack, which is john.comiskey.substack.com. And appreciate being on, Melody.
Thank you so much. Lux?
Well, I would like to leave this with the audience, is that any policies that are being made has a cascading, long-last impact. And it also comes with a lag. So any decision made at the policy-wise takes 3 to 6 months or sometimes a year to trickle down and come down. So imagine, think about this as since 2020. So whatever the decision that economic policies are made, stimulus packages and everything has a cascading effect, and everything is coming right now. And that's why you don't see things right away. If there is a policy there, you won't see the result now. So as John mentioned, there is going to be an impact. If One Big Beautiful Bill were to be passed, the administration wanted to be passed by 4th of July, which, if it were to get passed, there is going to be a huge impact to the bottom tranche of the consumers. And its consumer credit crunch is here, and it's here to stay. It is not going to be a point in time. You're not going to say, okay, from June to December, I'm going to feel the crunch. It's not going to be a point in time. It is going to be there for a long time, because every decisions, every policies that are made will have a lasting impact from 6 to 12 months range. So Make sure that you readjust your portfolio if you're an institutional investor, and if you're individuals, be very mindful. And like Melody said, there are a lot of noise out there, and we try to cut the noise to give the facts. And all, Melody, John, and nobody special, our friend, and myself included, we try to give you the facts, even though it's unappealing to the audience right now. Um, it is like a medicine that you need to accept the reality. So I like John said, in the second half of the year, people are going to accept the reality, and it's not going to be pretty. Um, that there is going to be a huge, not so pleasant macroeconomic impact for your personal point of view, to take care of your family as well as to take care of your finances. Just try to accept. The sooner you accept the reality, this better it will be for you to make the decisions. And that's our final take. If you wanted to find us, our firm is Unicus Research, at Unicus Research on X, at Lux MacArthur on X for my personal Twitter or X. To find us in covering the macro theme and insights, from student loan to credit card debt to the big black hole of US debt and how it cascades, everything cascades to the end consumers. You can follow us or subscribe to us on contrarianunicus.substack.com. And Melody, if you can just put the link there.
Oh, absolutely. Yeah.
People
I'll
who
put those
can't-
links down there
yeah.
for sure.
So thank you for having me here.
You got it. And you said something, Lux, that my final thoughts is, things are changing. We've been under what I believe are some illusions for some time, and awareness is happening out there. And as you say, the sooner you accept it, that you might have to make some tough decisions, because I do believe that when this is all said and done, it's going to impact the entire K, because of kind of that response that will have to happen once the noose really cuts off the bottom. The top will be impacted. And so, you're going to honestly, guys, this is a time where you need to be really honest with yourself about your finances and do whatever you can to reduce debt, because the people that are going to do better in this and what we see coming are those that are going to be free of debt, because that is those under stress are going to be in trouble. And as we know, at least right now, student loans cannot be discharged in bankruptcy. So there's significant stress coming for much of the country. And, hopefully, guys, what we're trying to do here, just like Lux also said, we're not here to try and depress you. We just want you to be able to see the actual facts on the ground with, we're all biased, but without as much bias as we can achieve, so that you really understand what's happening. So I just want to say thanks to both of you. I'm so appreciative. And we'll do more of this. I'm sure we'll be talking again, because there is great change afoot. So thanks, everybody, for joining. We'll be back with some great stuff very soon, just to keep you posted, and just eyes wide open as to what's really happening out there under, all of the headlines. Thanks again.
Thank you.